Welcome to the first video in our three-part series on linear programming. This video will cover an overview of linear programming. The second video will look at the graphical method of linear programming, while the final video will consider the simplex method. Let us consider our learning objectives for this video. First, we want to understand what linear programming is and when it is used. We then want to understand the concept of an objective function. Linear programming is based on various assumptions. We want to understand what these assumptions are. Once we have understood all these basics of linear programming, we want to briefly look at the two major linear programming techniques and when we should use them. We will work through each of these techniques in separate videos. Finally, we will discuss the various uses of linear programming for management accountants. In a company, our goal is to maximize value. In order to maximize value, we want to make sure that our resources are allocated optimally. When we have sufficient resources available to us, this is an easy task as we can simply allocate the resources to where they are needed. But what happens if we have scarce resources? Having a scarce resource means that we do not have enough of that item to meet production demand. It could be a raw material that is in short supply, or maybe we don't have sufficient labor hours to meet demand. Even having limited factory space could be a problem. If we have a single scarce resource, we can simply use the technique we discussed under our production mix decision in our series on relevant costing. Remember, the steps here were to firstly identify the limiting factor, secondly, to calculate the contribution per unit for each product, thirdly, to calculate the contribution per limiting factor, and finally, to produce the products with the highest ranking first, until we have met production demand and our scarce resource has run out. Now, this process is fine if we have a single scarce resource, but what if we have multiple scarce resources? This is where linear programming techniques come in. Linear programming is a mathematical technique that management accountants can use to optimally allocate resources. Now, to achieve the optimal allocation of resources, we first need to understand the concept of an objective function. The objective function is the quantification of our goals or objective. This would be to either maximize the profits from the resource allocation or to minimize costs. In order for us to be able to effectively use linear programming, we need to make a few assumptions. First, we must assume that all relationships are linear in nature. In order to comply with this assumption, we must assume that the contribution per unit is constant regardless of the output level. Likewise, we must also assume that the resources consumed per unit remain constant regardless of the level of output. Next, we must assume that an optimal solution does in fact exist. Finally, we must assume that the units produced and resources allocated are fully divisible. This means that we may get an answer of partial units, i.e., we may need to produce 10.5 units of a product. We then need to interpret this as manufacturing 10 units of the product, as we cannot manufacture partial units. Now that we know that linear programming is a technique used to optimally allocate scarce resources, we can briefly look at the two major techniques and when to use them. The first technique is the graphical method. The graphical method is conceptually easier as we are using pictures. We can use it when we have more than one limiting factor. However, it can only be used when we have two products, as we only have two axes on our graph. If we are producing more than two products, we need to use the simplex method. The simplex method is a lot more complex and uses matrices to arrive at the final solution. We will work through each of these techniques in detail in separate videos in this series. So, what can linear programming be used for? First, we can use it to calculate the relevant cost of a resource. When a resource is scarce, alternative uses exist for that resource that can provide a contribution. Therefore, the relevant cost of the resource is no longer just the purchase price, but rather the purchase price plus the opportunity cost. If there's more than one scarce resource, this opportunity cost must be calculated using linear programming. Next, we can use linear programming to determine if we should sell different products that use the same resources. As resources will need to be allocated away from our initial products, there will be an opportunity cost attached to the resources. We can then calculate the new product's contribution after deducting the opportunity cost, which was determined from linear programming. We can also use linear programming to determine the maximum we would be willing to pay for an additional unit of the scarce resource. We can use linear programming for cost control. So when we are performing variance analysis, the responsible department's cost should also include the opportunity cost of the scarce resources to highlight the true cost of inefficient usage of that resource. When a scarce resource is fully used, it is referred to as a bottleneck. Linear programming can help us to identify the bottlenecks so that managers can focus their attention on alleviating those bottlenecks. Linear programming can also be used in capital budgeting. What often happens in capital budgeting is that we have multiple projects in which to invest, but limited resources to execute these projects. This is known as capital rationing. Linear programming can be used to determine the optimal investment program. Finally, we can use linear programming to assist with sensitivity analysis. This brings us to the end of our overview of linear programming. In our next video, we will look at the graphical method of linear programming. See you next time.